So you shared a summary of Howard Marks' book, The Most Important Thing, and we're going to take a really deep dive into it today.
Looking forward to it.
Yeah, I think it'll be really fun. And, it's not just his perspective that he shares in the book, but he also brings in a lot of wisdom from other big names in investing, like Joel Greenblatt,
Yes.
Paul Nicholson, Seth Klarman, Christopher Davis.
A lot of great investors in there.
Yeah, so it's kind of like getting this, cheat sheet to decades of experience and wisdom in the market. And what we really want to extract here are like the most crucial strategies and also like what are the big dangers that investors need to watch out for?
Yeah. And specifically, we're going to go way deeper than just, buy low, sell high.
Right.
We really want to unpack the nuances of how to identify value, how to think about risk, which is always present.
Always.
And, just understand market behavior and the swings in the market that Marx and, these other investors that he quotes have really observed over decades.
And speaking of, going beyond just buy low, sell high, I think one of the most fundamental ideas in the book is this concept of second level thinking.
Yes.
Marx really emphasizes this as like the key to achieving above average returns. But what does that actually look like when you're, evaluating a potential investment?
So I think what's fascinating is how he contrasts second level thinking with what he calls mundane and mechanized.
Right.
It's very easy to look at somebody who's successful in the market and say, oh, if I just copy what they're doing, I'll have similar results.
Mimic them, exactly, yeah.
But second level thinking is much deeper than that.
Mm-hmm.
It's not just what you think about an investment, it's what you think about what everyone else is thinking about that investment.
So it's like you're anticipating what the crowd is going to do, not just following the crowd.
Exactly. You're thinking ahead, you're being more perceptive, and that's really how you identify opportunities that others might miss.
And you need that extra layer of analysis to see what other people aren't seeing.
Exactly. It's like, what is the consensus view here?
Right.
And is there a really good reason why I might believe something different in the consensus?
Right.
And that's where the real opportunities, the real value can often be found.
And that kind of leads us right into this whole concept of value investing, because the book really emphasizes that, buying low and selling high is more than just the price tag on a stock.
Absolutely. I think, Marx takes aim at the efficient market hypothesis.
Right.
Which, in its stronger forms says that all information is already factored into a stock price, so the price is always right.
Right.
And, he uses some really compelling examples to poke holes in that.
Yahoo in the early 2000s.
Exactly. Yeah. So you had this dramatic rise in Yahoo's price and then this huge fall.
I mean, a really big fall.
And what that tells you is that the market isn't always right.
Right.
If you want to beat the market, you have to have a view that's unique and different.
So what was that period like for you? I mean, what did that tell you as an investor?
Well, it really kind of screamed to me that just because something has a high price doesn't mean it has a high underlying value.
Exactly.
And the reverse is also true.
Yes.
So, I mean, to really outperform in the market, you have to be able to kind of form your own independent assessment of what something is worth. And that's where this whole discipline of fundamental analysis comes in, really digging into the specifics of the company.
Absolutely.
Its financial health, the quality of its management, its position in the market, its future growth potential, all of that.
Yeah. And really trying to come up with your own estimate of what that company is worth.
Right.
Its intrinsic value. And the principle is very simple. If the market price is significantly below what you think it's worth, you buy.
Aye.
And if the market price is significantly above what you think it's worth, you sell. And that can involve all kinds of different analyses, right? I mean, you might look at the company's financial statements. You might, try to assess the management team. You might look at their competitors.
Absolutely.
All kinds of things go into that.
That's really doing your homework.
Yeah. But the book also has a really important warning about just focusing on a low price.
Yes. And this is really important. No asset is too good to be true at any price.
At any price, right.
So something might be incredibly attractive at a low price, but if you end up overpaying for it, even if it's a great company,
right,
it can be a bad investment.
Right. So that relationship between the underlying fundamentals,
yes,
the Q value of a business, and then the price you pay is so key.
Absolutely.
Okay, so we're on the hunt for value.
Yes.
But we can't talk about investing without talking about risk, and the book tackles this head on.
It does. Marx is very clear that uncertainty about the future is inherent in investing. You can't eliminate risk.
Right.
And he challenges some common but flawed ideas, like the notion that you can sit it out when prices are high and be risk-free.
Right. Or that just because something's cheap,
Yes.
it's low risk.
Yeah, low price does not equal low risk. Just because something's cheap doesn't mean it can't get cheaper,
Right.
or that the problems that are causing it to be cheap aren't severe.
Right.
And he really emphasizes 3 key things when you're thinking about risk.
Okay.
First, understand your own tolerance for risk.
Right. Your own personal risk tolerance.
Exactly. How much can you afford to lose?
Right.
Second, really think about the potential returns that you might achieve relative to the risk that you're taking.
So it's that risk-reward calculation.
Exactly.
Oh.
And third, do a thorough assessment of the risk itself.
Okay.
What are the possible negative outcomes? What could go wrong?
So it's not about avoiding risk altogether.
Right.
Which it sounds like it's impossible anyway.
Pretty much.
But it's really about understanding it, managing it,
Yes.
and maybe even using it to your advantage. Exactly. It's about mitigating and controlling risk in a smart way.
To improve your odds of success over the long term.
Exactly, because as the book highlights, truly skilled investors are often distinguished by their ability to manage risk effectively while still generating good returns.
Now, a theme that really runs through the book is this idea of market cycles.
Yes.
The stock market isn't just this kind of, random walk. It actually has these patterns that repeat over time.
Yes. And he describes it very much like a pendulum swinging back and forth.
Oh, that's a good analogy.
The mood of the market is never constant. It oscillates between extremes.
Okay.
So you have periods of high risk aversion and then periods of excessive risk tolerance.
Right.
Fear, greed,
Right.
pessimism, optimism.
Low prices, high prices.
Exactly. And so you see these patterns over and over again. And what's so fascinating is that you can observe them, but you can't predict exactly when they're going to happen.
When they're going to turn, right?
Yeah.
Exactly. We all know that the pendulum swings, but we don't know exactly when it's going to change direction.
So we should be suspicious of people who say, oh, this time it's different.
Yes. Very suspicious.
But we should at least be aware that these shifts are inevitable.
Exactly. And paying attention to these cyclical patterns can really enhance your investment decision-making.
Even if a lot of other people have forgotten about the cycles.
Yes. Or if they think that this time it really is different.
Right. They've been broken or something.
Yeah. And, the book suggests that recognizing where we are in these cycles increases your probability of success over the long run.
And I think what's really interesting is that for people who, don't have the time or the expertise to kind of track these market ebbs and flows, the book even mentions solutions like balance advantage funds.
Yes.
Which actually try to adjust their asset allocation based on market conditions.
That's right. So they have this kind of built-in mechanism to try to navigate those cycles.
Right. And that can be really helpful for a lot of investors who, want a more hands-off approach.
Absolutely.
Now, another thing that Marx really emphasizes in the book is this importance of, continuous learning.
Yes.
And being aware of the limits of our own knowledge.
Right.
And all the different negative influences that are out there that can impact our decisions in the market.
Absolutely. And this ties right back into this idea of market inefficiencies.
Okay.
Marx argues that the very inefficiencies in the market, the mispricings, the miscalculations.
Right. The mistakes other people make.
The mistakes other people make, those create opportunities for investors who are knowledgeable and self-aware.
Self-aware, that's a really important point.
And part of that self-awareness is recognizing the limits of your own expertise.
So knowing what you don't know.
Yes. Intellectual humility is really key.
So avoiding overconfidence can be a real edge in the market.
Absolutely. And also recognizing that market highs and lows are just part of the landscape.
They're inevitable.
They are. And understanding how those swings can affect market performance and also investor psychology.
Yeah. How we feel, how we react.
Yeah, that's critical. And the book really cautions against setting unrealistic expectations.
Yeah.
Especially the desire for high returns without any risk.
Which is so tempting.
It is, and it's often fueled by greed and fear.
The two big emotions.
The two big emotions in the market, and perhaps most importantly, it emphasizes the need to resist the herd mentality.
The urge to follow the crowd.
Yes, because so often the crowd is wrong.
And that leads us to another crucial element that the book highlights, and that's patience.
Yes.
It's not always about making a lot of moves in the market.
No.
Sometimes the most profitable action is inaction.
Absolutely waiting for the right opportunity.
Waiting for the right pitch.
Exactly. And the book really suggests that waiting patiently for those really compelling opportunities is far more effective than constantly chasing every hot tip or trend.
Yeah, chasing the next big thing.
And it introduces this really interesting idea that I think is so powerful.
Okay.
Focus on buying things that a seller has a reason to sell,
Okay.
not just what you as the buyer want.
Yeah. So understand the motivation on the other side of the trade.
Exactly. Because, there are times when somebody really needs to sell something.
They have to.
They have to. And that can create an opportunity.
For you to get a bargain.
Exactly.
So it's about seeing the full picture,
It is.
not just your own little piece of it.
And, Marx argues that adding real value as an investor goes beyond reacting to market demands.
Okay.
It requires second-level thinking.
That deeper level of analysis.
And he says that value is the bedrock of a successful investment career.
Value.
Yeah. It's the ability to really analyze a situation based on the facts and figure out when to buy and when to sell.
And he has this great quote in the book that really captures this contrarian mindset.
Yes.
He says, the key to success lies in the fact that you sometimes do the opposite, even if the trend dictates that you become part of the herd.
It's powerful.
Really powerful. But the book also makes it clear that, sophisticated investors aren't just buying the cheapest stocks they can find.
Right. Because as he points out, there might be a really good reason why a stock is cheap.
Yeah, there might be something wrong with the business.
Exactly. So it's about evaluating those seemingly cheap options based on your own criteria.
And your own risk tolerance.
Absolutely.
And the book also, I think, injects a little dose of realism.
Yes.
By acknowledging that luck can play a role.
It can.
Sometimes unpredictable events lead to outsized returns.
Absolutely.
That, maybe nobody could have really predicted.
Right.
So while skill and a disciplined approach are crucial over the long term,
absolutely,
there is that element of chance
yes.
that can sometimes really influence things.
In the short term.
Right. Yeah. And finally, the book, really emphasizes this idea of investing defensively and being aware of all the potential pitfalls.
Things that could go wrong.
Yeah, that can derail even the best investment strategies.
Yes. And it's not just about maximizing gains.
Right.
It's also about minimizing losses.
Protecting your capital.
And Marx talks about this balance between offense and defense.
Offense and defense. I like that.
Offense is about aiming for growth.
Okay.
Defense is about preserving capital.
And you have to decide where you fall on that spectrum.
Exactly. And he argues that focusing on avoiding losses by recognizing those common pitfalls is a really sound strategy.
It's often overlooked.
It is.
Yeah.
And he identifies greed and fear as the main sources of those mistakes.
Those two emotions, again.
So really, work to counteract the influence of those emotions on your decision-making.
Be aware of them.
Be aware of them.
So to kind of bring it all together,
yes,
this deep dive into Howard Marks' book, The Most Important Thing, has really highlighted how interconnected all of these principles are.
Absolutely.
Managing risk, thoughtfully cultivating that contrarian thinking, understanding market cycles.
Yes.
Grounding your decisions in value, recognizing those market inefficiencies, being patient, being disciplined.
It's a whole philosophy.
It really is. And understanding the impact of psychology on market behavior. Maintaining intellectual humility and always keeping that long-term perspective in view.
It's a long game.
A long game. And it really is a comprehensive philosophy.
Yeah.
So considering all these interconnected insights,
okay,
I want to leave you with this thought.
Okay.
What is one area of your current investment approach that you might reevaluate? Not necessarily to change it completely,
right,
but to really, think a level deeper about it.
Engage that second level thinking.
Maybe view things from a slightly different perspective.
Yeah, I love that.
So thank you for joining us for this deep dive into The Most Important Thing.
It's been a pleasure.
It's been great. And remember, it's an ongoing process of learning and adapting as we navigate the complexities of the market.
Absolutely.
Thanks again.
Thank you.